Welcome back to Algobot, the channel where we take apart automated trading strategies and study how they actually work, line by line. I'm your host, and today we're exploring an expert advisor for MetaTrader 5 called Run's Test Regime Switch. This one is built around a classic statistical tool, the Wald-Wolfowitz Run's test, and it uses that test to judge whether the market is trending or ranging. Then it switches between two completely different playbooks to match. By the end of this video, you'll understand the statistic, the entry and exit rules, and the code that ties it all together. Let's get into it. So what exactly is this expert advisor doing? At its heart, Run's Test Regime Switch is a regime classifier. Instead of assuming the market is always trending or always ranging, it measures the current state of the market directly and then adapts. The tool it uses for that measurement is the Wald-Wolfowitz Run's test, a well-known statistical method for judging whether a sequence of ups and downs is random or structured. Here is the core idea. On every completed bar, the strategy looks at the last 20 close-to-close price changes and records only their sign, whether each change was up or down. A run is a block of the same sign in a row. If price is trending, you get a few long runs. If price is chopping sideways, you get many short runs as the signs flip back and forth. The Run's test converts the number of runs into a z-score that compares what we observed against what a purely random walk would produce. That single z-score does all the work. A strongly negative reading means fewer runs than chance, long streaks, a persistent trend, and the EA switches into its momentum book to trade with the drift. A strongly positive reading means more runs than chance, choppy alternation, an anti-persistent range, and the EA switches into its mean reversion book to fade stretches away from the average. When the reading is close to zero, the market looks random, and the strategy stands aside. Both books trade long and short, and every trade uses stops and targets based on the average true range, so position risk adapts to volatility. It runs on a single time frame, whichever chart you attach it to. This design suits traders who are curious about adaptive, statistics-driven systems and who want to study how one measurement can drive two opposite behaviors. As always, this is educational information, not financial advice. Let's walk through the mechanics step by step. The EA acts once per completed bar. On each new bar, it appends the bar that just closed to a rolling buffer, then rebuilds 3 series from that buffer: highs, lows, and closes. From those, it computes the average true range over 14 bars, which it uses for both risk and for measuring stretch. Next comes the heart of the system, the Run's test z-score. The strategy walks the last 20 close-to-close changes in order. Flat changes, where the close did not move, carry no sign, and are skipped. Every up change adds to the up count, every down change to the down count, and a new run is counted each time the sign flips. If there are fewer than 10 usable changes, there is not enough data to judge, and the EA waits. If every change shares the same sign, that is one unbroken run, the most persistent case possible, and the score is pinned to its extreme. Otherwise, the observed run count is standardized into a z-score against the random walk mean and variance. Now the decision. If the z-score is at or below the negative threshold, 1.5 by default, the regime is persistent. The strategy measures the net move over the window. If that move is positive, it enters long. If it is negative, it enters short. This is the momentum book trading with the established drift, and its take profit is set 3 ATR in the direction of the trade. If instead the z-score is at or above the positive threshold, the regime is anti-persistent. The strategy compares the latest close to a rolling mean over 12 bars. If price is stretched above that mean by at least 0.8 ATR, it fades with a short. If it is stretched below by the same amount, it fades with a long. In both cases, the take profit aims back toward the mean, where fair value is estimated to sit. For both books, the stop loss is placed 2 ATR from the entry, and only one position runs at a time for this strategy's magic number. If the z-score sits between the two thresholds, the market looks indistinguishable from random, and no trade is taken. Let's read the actual MetaTrader code on screen. At the top are the inputs you can adjust in the strategy tester. WindowN, 20 by default, is how many close-to-close changes feed the Run's test. ZThreshold, 1.5, is how far the z-score must travel before a regime counts as non-random. Rev period 12 is the rolling mean for the fading book, and MinStretchAtr 0.8 is how far price must stretch before we fade it. ATR period is 14, and SLATR multiple and TPTR multiple 2 and 3 set the stop and target distances in ATR multiples. Below that is the first decision block. When Z is at or below minus ZThreshold, we are in the persistent, trending regime. The code checks the net move over the window. If it is positive, it calls inner long with a take profit 3 ATR above the ask. If it is negative, it calls inner short with a target 3 ATR below the bid. That is the momentum side, going with the drift. The second block runs when Z is at or above plus ZThreshold, the ranging regime. It computes the deviation of the close from the mean and a trigger equal to MinStretchAtr times ATR. If price is stretched above the mean, it calls inter short and aims the take profit back at the mean. If it is stretched below, it calls inner long, aiming back up at the mean. Finally, the two helper functions. Inner long sets the entry at the ask and the stop loss 2 ATR below, then calls trade.buy. Inter short sets the entry at the bid and the stop 2 ATR above, then calls trade.sell. Each one guards the order, so the stop and target sit on the correct side of price before anything is sent. Let's bring the logic to life on a chart. Up top, we have price candles, and in the lower panel we have the runs test z-score, the single statistic that drives every decision. Two dashed lines mark the regime boundaries, the lower one at minus 1.5 and the upper one at plus 1.5. When the z-score sits below the lower line, the market is behaving in a persistent way, meaning price changes are streaking in one direction, and the strategy treats that as a trend. When the z-score climbs above the upper line, price changes are alternating back and forth, an anti-persistent or ranging state, and the strategy prepares to fade. The sloping line drawn across the candles is the rolling mean that the fading book targets. We open on the left with a steady climb. Each candle closes a little higher than the last, so the close-to-close changes keep printing the same positive sign, one after another. Down in the panel, the z-score is diving. As we reach the third candle, it pushes below the minus 1.5 line and into the persistent zone. That is the momentum book waking up. The strategy checks the net move over the last 20 bars, sees that it is clearly positive, and places the buy entry marker you can see here. Because the regime is a genuine trend, the plan is simple: ride with the drift. The stop loss is set 2 ATR below the entry, and the take profit is placed 3 ATR above it, a reward to risk of about 1.5 to 1. Now watch the next few candles. Price keeps grinding higher, candle after candle, exactly the behavior the persistent reading predicted. By the sixth candle, price reaches the take profit target and the long trade closes. Notice that the strategy never argued with the trend. The statistic said the streak was unlikely to be random, so the EA simply stayed with it until the target was met. After that push, the character of the market changes. The next candles stop trending and start chopping, up one bar, down the next. Those alternating signs are exactly what an anti-persistent market looks like, and the z-score responds by climbing. It crosses back through zero and, by the ninth candle, pushes above the plus 1.5 line into the range zone. Now the reversion book takes over. On that ninth candle, price spikes up and stretches well above the rolling mean line, clearing the minimum stretch requirement of 0.8 ATR. Since the regime is ranging rather than trending, a stretch that far from the mean is treated as an overextension that is likely to snap back. So the strategy places the sell entry marker here, fading the move. The stop loss sits 2 ATR above the entry, and the take profit is aimed back at the rolling mean, right where fair value is estimated to be. From there, the fade plays out. Price rolls over on the 10th candle, then the 11th, each close stepping lower and pulling back toward that mean line. By the 12th candle, price reaches the take profit target at the mean and the short trade closes. This is the whole idea of the strategy in one picture. The same runs test statistic told us to follow the trend on the left and to fade the range on the right, and it produced a long trade and a short trade from two opposite playbooks. And if the z-score had stayed between the two dashed lines the whole time, the reading would have looked random, and the strategy would have simply stood aside and waited. No clear regime, no trade. That patience is a core part of the design. And that brings us to the end of our breakdown of runs test regime switch. We covered the Wald-Wolfowitz runs test and how it measures whether the market is trending or ranging, the two opposite playbooks the EA switches between, the exact entry and exit rules, and the MetaTrader code that runs it all. The big idea to take away is that one statistic can classify the market and then hand control to whichever book fits the moment. Remember, everything here is educational information only and not financial advice. Trading carries real risk, and losses do happen. If you found this useful, please like the video, subscribe for more MT5 strategy breakdowns, and leave a comment telling me which strategy to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.